watch the news and you're like, why does that matter? Because that happened, the stock market's crashing, doesn't make any sense. So what we're going to do today is we're going to analyze the data that came out today. I'm going to show you a clipping from CNBC. Then I'm going to put it in context for you so you can understand what's going on and why. Because our goal here on the channel is to educate and inform you guys everything real estate, especially when it comes to the financing. So let's see what Rick Santelli has to say for today. And then let me put it into common terms so you understand the why. So take it away.
Oh my God, guess what it is? 390,000. 390,000. Where have I heard that number before? And if we look at private payrolls, 333,000. We have a cumulative 2 months of revisions that take away 22,000. Manufacturing payrolls, about half of what's expected at 18,000. And just to put a face on it, 390,000 is a pretty good number, but it does break the streak of 12. 1 year in a row, 400,000 or higher. On the unemployment rate, 3.6. It holds at 3.6, and we all understand that these numbers go back, 53 years to the late 1960s on the unemployment rate. Average hourly earnings, a little bit of a miss, up 0.3. However, on the year-over-year side, it is up 5.2. Now, 5.2 equals February, and it is now 5 months in a row, January, February, March, April, May, that are all above 5%. That's a nice run on work week. 34.6, holding quite steady. And the participation rate, drum roll, finally we move up 0.1 to 62.3 after 62.2. Do remember 63.4 is where we were in February pre-COVID. The underemployment rate, known as U6 on the inside game, 7.1%. That moved up 0.1. The high water mark there was March at 6.9%. So cumulatively, I personally think it's a pretty good report. We could debate the month-over-month earnings at up 0.3%. On the interest rate side, interest rates are up a bit. That's a good sign. 2.94 on 10 years, so they're looking at the number in a positive way. Real quickly, bond yields are up 30 basis points on the week. They're 10-year. They're 2 years up 27 basis points on the week. The world's interest rates are moving up. Gang, back to you.
Now let's put it all in context. What did he just say? He said, jobs this and unemployment rates and this, the U6 this and 3.6 and all this other stuff. So let me explain this to you. The whole buzzword in the world right now is the Federal Reserve. And they basically are pulling the purse strings on everything. And we see the stock market go up and down based on what they say. But they have two main mandates. And I know I say this every day, but this is basically where the context comes into play. Federal Reserve has two mandates. One is job creation, or 100% job. They want basically as many people working as they possibly can. The next thing is price stability, aka inflation. So today's numbers, we saw a big report in regards to the jobs numbers. So Rick Santelli said there's 300 new jobs that were created. Okay, so that's pretty easily understood. The unemployment rate ticked up a little bit. Well, there's a lot of factors that go into that, but just take that with a grain of salt, because I truly don't even think that that's the number. Then the sheet comes out with the U6. That's another number that we focus in on. But the biggest thing I want you to see is just the trends. Where were we? Where were we pre-pandemic? Where are we now? Where were we during the pandemic? So we're seeing a nice recovery in the jobs market, not as robust as everybody thought it was going to be. The Federal Reserve about a year ago now said, we're not going to raise rates at all until we see at least 3 or 4 consecutive months of a million people getting jobs. Well, we just saw today that there's only 390,000. So why is the Fed doing what they're doing? Because inflation all over the place is getting out of hand. One good context in this is we also see wage growth. So wage growth, you might not see it. I'm feeling the pain at the pump in the grocery store as well, but we're seeing at least some wage growth here. Not huge, but it's a good direction. So what we're seeing in today's numbers is jobs are coming back slowly but surely. We do have some growth in income. And then the last piece of the puzzle, he said, basically the whole world is raising their interest rates. I follow this as well, just Canada, the EU, people every day that I don't really focus in on here and explain it to you guys, but every kind of day or once a week, we're getting where other countries are raising their interest rates. Okay, so that's nothing but good news to taper this inflation that's going on. So hope you find that good context, because again, the focus here is on the Fed, what they're saying, what they're doing, and they look at the employment numbers, inflation numbers. Hopefully that puts it in a little more context with you. If you like this video and you like others, please don't forget to subscribe. We also have a free newsletter down there. There's no catch. Sign up for the newsletter because you're going to get context like this every morning. So let's get on to what this is doing to the markets. So we see the headlines right here. I'm going to get my head out of the way. You're going to see the headlines right here. U.S. economy added greater than forecasted 390,000. Well, the forecast is dismal. So anything above, their dismal numbers is a good number. But again, put it in context. Last year, the Fed wanted to see this number here. At a million jobs added per month. Let's see what's going on in the stock market. The stock market doesn't like that. Dow's down almost 300. NASDAQ's down almost 200. So the markets don't like this right now. And you're going to see headline news everywhere about the jobs report, better than expected. Well, that's great news. Why is the market's crashing? Okay, so let's go over to the economic calendar to re-verify these numbers. So we're going to go over here, and we are at Friday right down through here. Non-farm payroll, 390,000. The expectations were 325. Well, last month was 436. So we're down from the previous month. So it came in higher than expected, but we're quite a bit lower than where we were last month. The unemployment rate ticked up. Again, I'm going to take this with a grain of salt. These numbers, we have a participation rate. He said a number there, and I'll explain to you what that is. I don't know if you noticed it, but he said the participation rate ticked up a little bit to 63%. That means 63% of the people are trying to get a job or participating in surveys or giving us the information that's needed. So you still have 30+% that we don't even know what's going on with. So take a lot of this with a grain of salt. I try to dig into it to decipher the news, good or bad, for you guys. So the next piece of the puzzle, let's get into what's this doing for mortgage rates. Well, mortgage rates, this is what happened or where we were at the close of yesterday. And I'm going to show you the MBS market here in a second to show you the direction that rates are going to take today. We had a nice little drop in some areas yesterday. So let's go through where rates are today. Now, these are rates posted by Mortgage News Daily on a daily basis. They survey lenders all over the country. This isn't a particular loan or a particular client or a particular bank. Think of this as the Dow Jones. Look at this as just what direction are things going? Are rates going up or going down? Okay, and at what increments? How big of a move is it? Like we see the Dow Jones is almost down 300. So that means your stock, if you own any stocks, probably down a percentage or two. Okay, so that's why we focus in on these, because Mortgage News Daily does a great job. They post multiple times a day, and they give an easy to read format. So let's go across here, and I'll show you where rates are today, and then we'll get to the MBS market to see what effect all this news is having on rates when rates open up this morning. So we start out with the 30-year fixed rate. It's down 4 basis points to 5.43. That's in this cell here. We go across. 15-year fix is down 3 basis points. That's what we call this, basis points. So 0.03 means 3 basis points. The minus obviously is a minus. Coming in at 4.79. Jumbo's still one of the ones that came down a little bit yesterday, not much, but down 1 basis point to 4.7. Now we're down through here where they bucked the trend. Rates are up on the 5-year arm at 4.55, up 7 basis points. FHA is up 2 basis points to 4.82. VA is at 4.9, completely flat. You're going to see the chart down here, a 10-year chart. We are in uncharted territories, and the sentiment of the day is way to the right, and that is not good. MBS market, let's see where we're going. This is the bond that trades on Wall Street. Let's see where we're at. I'll refresh it. Oh, we're recovering a little bit. Right out of the gate, we were down about 35. So we are starting to recover a little bit there. This number right here represents the price of a bond. There's an inverse relationship. And I'll say, basically that means a flip-flop relationship. As this number goes down, rates go up. The bigger this number goes down, the higher rates go up. So we love this when this is going up because mortgage rates come down. Okay, again, it's a flip-flop. You can see the chart down below. I'm still pretty sure we hit a short-term ceiling down there, or I'll say bottom, and I think rates are going to stagnate from here for a while unless the Fed comes out and just throws everybody a curveball. So we're seeing some stability there, and at least we're recovering. We don't have that complete drop in the MBSs again, because when this chart drops, rates go up. All All right. So if you want to find out more about this news and keep up on the daily news, here's my newsletter. You can subscribe down below. It's completely free, no catch. We don't sell the data or anything, and it gives you a bunch of information. It gives you alerts throughout the day, and it gives you a weekend snapshot of the week. It gives you economic calendars, what the MBS market's doing, and what the other markets are doing, and interest rates. So if you like my video, if you would, just check us out. My team just joined a federally chartered bank. So at this point, and we're making the transition over. So at this point, most of my loan officers are now federally chartered. So if you're anywhere in the country, we'd love to help you. My team is now at affiliate, Allied First Bank, and we're federally chartered. I can show you that down through here. So that means, okay, no matter where in the country you are, you should be able to help. So if you want to find out more about me and my team, just go to therateupdate.com right here, and you're going to be able to call us. You're going to be able to chat with us, and you can even apply online. So if you're looking to buy a house, build a house, refinance, reverse mortgage, debt consolidation, home equity loans, anything you're looking at in regards to residential lending, we should be able to. So thanks for watching the video. Have a great weekend. God bless. Be safe, and I'll see you Monday.